So welcome back to Financial Accounting, everybody. Purpose of this little mini exercise is to review the in-class exercises that we did last Wednesday from Chapter 13. Just a reminder to you, I'm probably sounding like an open record at this point, but the final exam will cover the last three chapters. The final exam will be a take-home exam, and the final exam will not be the same questions, but will be similar in terms of focus as these in-class exercises. So it's always a good idea to give me your undivided attention when we do in-class exercises in class. Also a good idea to revisit them in these recorded lectures, and an especially good idea to go through all these as part of your preparation for your exam. They were questions, however, managing expert, not going to be the same questions, but they will be similar in focus. So with that background, let's jump right to it. Okay, exercise 1. So this one had to do with the issuance and purchase of stock. Let me move my head here a little bit. There we go. The issue and purchase of stock. And a couple of things to bear in mind as we look at the fact pattern here. So they were authorized to issue 1 million shares. That doesn't mean that they went ahead and issued 1 million shares, but their charter gave them the right. When it says authorized, that's the number of shares that the charter tells them they're allowed to issue. And the shares have a par value of $5, which means, and this is Phoenix's specialty here, when you sell the stock for more than $5, you have to recognize additional paid-in capital from the sale of stock. And the par value is generally set at a pretty low value, so normally you sell the stock for more than its par value. Also, I know further on in here that we have the cost of organizing a corporation. Those are called organization expenses. Those are generally capitalized. So if we have any costs associated with organizing the corporation, we're going to be debiting an intangible account called organization expenses. Also, if we have treasury stock, which I believe we do, the company is not allowed to recognize gain or loss on the purchase or sale of its own treasury stock. If they sell the stock for more than they paid for it, Phoenix, I can hear you now, additional paid-in capital from treasury stock. And if they sell the stock at less than they paid for it, you don't recognize the loss. You have to debit paid-in capital from treasury stock, but you can only debit it to the extent that you have a balance in that account. So with that background, let's take a look here. So on January 15th, and you got to do journal entries, lots of journal entries. So please be prepared to do these journal entries here. Paid $5,000 for incorporation fees. Well, the costs of organizing a corporation are called organization expense. And here we paid cash, so it's a debit to organization expense and it's a credit to cash. January 15th, issued 500,000 shares for $6 per share. So the par value is 5, so we sold them at 6. So 500,000 shares issued at one more than the par value. That sounds to me like additional paid-in capital in excess of par. So here's your full journal entry here. So we debit cash for the amount received for the shares. So 500 shares at $6 a share, that's $3 million. Common stock is credited based on the par value, so that's 500,000 times 5. And we called the difference paid-in capital in excess of par. January 30th here, attorneys for the company accepted 500 shares of common stock as payment for legal services rendered in helping the company incorporate. The legal services are estimated to have a value of $7,000. When you issue stock for something other than cash, you have to ask yourself, what's more readily determinable, the market value of the stock or the market value of the asset or expense you get in exchange? So in this particular case here, since the stock doesn't have a market value because it's a brand new company, what's more readily determinable here is the attorney's, more objective is the attorney's bill. So we got a bill for the attorney for $7,000. We accept 500 shares. So there's my debit to organization expense based on the attorney's bill. 500 shares at $5 gives me $2,500. That difference, I can hear Phoenix saying it now, is paid-in capital in excess of. July 2nd, things change a little bit now. We got another asset in exchange for the stock, but in this particular case, we know that the stock is currently traded, and it's currently traded at $8 per share. So now what is more readily determinable is not the value of the land for which we have an asking price. You know that asking price is likely to be more than we paid for it. It's based on the market value of the share. So 800,000, $8 times 100,000 gives me 800,000. So I got 100,000 shares at $8. That gives me the 800,000. Common stock at $5. The difference is paid in capital in excess of par, 300,000. Treasury stock, we use the cost method for treasury stock. So we bought 15,000 shares at $9 a share. So I simply multiply 15,000 times $9 a share, and I get 135,000. So I debit treasury stock, I credit cash. Treasury stock is a contra stockholders equity account, which means it shows up on the balance sheet with a debit balance. So when we do the stockholders equity and we get to exercise 3 here, we're going to see treasury stock. Treasury stock is going to be a subtraction. And on December 6th, we sold those shares that we paid $9. We sold them for $11. So you might be tempted, little devil appears and tempts you there, to recognize a $2 gain, but you only do not recognize gain or loss on the purchase or sale you on treasury stock. So any amount received above the $9, which in this case is $11, so it's $2 a share, that becomes additional paid in capital for the sale of treasury stock. So 11,000 shares times 11, that's what we sold them for. That gives me 121,000. Treasury stock, 11,000 shares at $9 a share, that's just 99. And then the difference is the additional paid in capital from sale of treasury stock. If those shares had been sold at a loss, we would have debited paid in capital from sale of treasury stock. But we could only debit that to the extent we already had a balance in there. And if there was no balance, an additional paid in capital from treasury stock, we'd actually have to end up debiting retained earnings. I think we're going to see that in the next problem. Okay, so that's exercise 1. You might want to stop and pause here and just reflect on that before going on to the scintillating lecture. Here's exercise 2, and the transactions are very similar to what you had in exercise 1. I think the only difference is here we had treasury stock at a loss. So we had issued 30,000 shares of $2 par value. This sounds like an existing company. So we issue shares in exchange for cash. That's very straightforward. And now here it gets more complicated. We purchased 6,000 shares of stock at $8 for the treasury. On June 1st, we sold them at $10 a share. Okay, then we have a gain. But then on September 1st, we sold 3,000 and we took a real bath on these. We sold them at $6 a share when we had paid $8. So we get to record the quote unquote loss on the treasury stock. Remember, you can't debit additional paid in capital from treasury stock beyond what its balance is if they're actually sold at a loss. So without further ado, let's go to the transactions here. So on July 1st, we issued shares. And we issued 30,000 shares of $2 par stock in exchange for 150,000. So I got a debit to common stock, 150,000. 30,000 shares times 2, that's where I got the 60,000. So the difference there, I can hear Phoenix yelling it now, is additional paid in capital in excess of par. March 1st, I purchased treasury stock. So I purchased 6,000 shares at $8 a share. So that's where I get the 48,000. Debit treasury stock, credit cash. So the basis for gain or loss on this treasury stock, which we know we don't recognize as gain or loss, we recognize it either as an increase in additional paid in capital from sale of treasury stock or a debit to paid in capital of treasury stock, is the we sold these shares for $2 more than we actually paid for them. So purchased 1,500 shares at 10. That's the 15,000. Treasury stock, $8 a share times 1,500 gives me the 12. So I got it now a credit in additional paid in capital from sale of treasury stock of 3,000. If these shares are sold at a loss, which I think happens in the next problem, the next transaction, I can't debit treasury stock for more than the balance that's already in there. So this is what happens on September 1st. I sell 3,000 shares at $6 a share. That gives me 18,000. But the treasury stock, I paid $8 a share. So I got 24,000 there. Well, how do I account for the $6,000 difference? Well, I can debit treasury stock, additional paid in capital from the sale of treasury stock for 3,000. And then still I got another 3,000 I have to account for. If that ever happens, and you sell it at such a large loss that it exceeds the balance of additional paid in capital from treasury stock, then it becomes a debit to retained earnings. So take a little pause, reflect on those transactions. And on the third one here, we're given a bunch of information. Here's where you got to do your Wayne Gretzky. Imagine the puck going in the net. Rangers got 7 pucks in the net last night. That was very good. I think I have one Islander fan in the class. I don't know if the Islanders have won as many games now as the Rangers in a row. I think that was our 6th or 7th consecutive victory. So I hope I don't jinx them when they play Pittsburgh. But anyway, get that vision of Wayne Gretzky shooting the puck at the net. Why did they go in so often? He had a vision of it going in. So when you want to prepare your statement of stockholders' equity account here, or this partial section of the balance sheet, have a mental picture. So we're going to show the paid-in capital first. So we're going to show the preferred stock and the common stock. Then we're going to show any additional paid-in capital, in excess of par. That's going to give us the total paid-in capital. We're going to add to that the retained earnings, and that's going to give us paid-in capital plus retained earnings. And then we're going to subtract out the treasury stock, and that'll give us total stockholders' equity. So this is jumbled here. We know that we do the paid-in capital. So here's all the information I need, but they're deliberately put in an order to test your understanding of where they go. So paid-in capital, so I start with the preferred stock, then I show the common stocks. Okay, so that gives me the total capital stock between preferred and common. Then I show the additional paid-in capital in excess of par, and that gives me the total paid-in capital. So it's the par value plus the additional paid-in capital. Add the retained earnings, and that gives me total paid-in capital and retained earnings. And I subtract out the treasury stock, and that gives me total stockholders. All right, so I would be prepared to do one of those, prepare one of those statements. All right, so I hope you found that little review useful. So, and again, I suggest you do all of this, go through all these little mini lectures as preparation for your final exam. So look forward to seeing you on Wednesday when we'll do chapter 18, and I will distribute the final exam. Be well, everybody. Hope you enjoy your week. Bye-bye. See you Wednesday.